we're going to be talking about one of my favorite things, which is derivatives and foreign currency. We're going to look at some common transactions. I don't know if we've all seen the movie The Big Short. Great movie to watch, kind of fun. A lot of it is about what kind of caused the financial crisis of 2007 regarding subprime mortgages. And a lot of that came out of the use of what I like to call exotics, which are unusual investment devices that are basically designed to manage risk and also package up products, investment products that can be used for basically managing different types of risk. They're usually kind of complicated to understand. It's not your basic stock that we've been looking at up until this time. It could be act like an insurance policy so that if a commodity like oil or gas or vegetables or anything that's a commodity basically fluctuates in price, and what a derivative does is basically insure the person that needs that product for a long-term um, amount of time from having price fluctuations. So certain industries do not operate well, like most industries don't, operate well in price fluctuation. And so what happens is they lose control of what their variable costs, their direct costs are, and it makes it very hard for them to price the product. So before I hop on, I'm just going to give you a little example of that really quick. It's not on the slide set, but I'll just explain something. A great example of using derivatives is using oil derivatives for airlines. So when we look at like an airline like Southwest Airlines, for example, um, the price of oil, as you can imagine, you go to the gas station, the price of gas flies all over the place, right? Sometimes it's low, sometimes it's high. Right now it's about $2, 2.5. It's been up 3 and 4 depending on what part of the country you're in. In some areas of the country, like in Texas, it might be a buck 50 right now. So let's say you're a large airline and you're trying to price products. So what happens is you come in with this idea that it's going to be like a buck, right? A buck a gallon, okay? But you don't know that, right? So if you're charging a buck, all right, and or if you're being charged $1 and your airline ticket is $99, right? Um, okay. If the price of the if the price of oil goes up or down and your price of gas or whatever fuel you put in airlines goes up a buck, that's going to shave your margin, your gross margin, from like $98 to whatever it is. It could be 95, 96, whatever. So on a larger scale, like 200,000 flights going per day, I don't know exactly, 200,000 passengers going through per day, you can imagine that a little creep and a few pennies in gas price can really mess up an airline and the function of an airline and the margins on certain industries. Another example of that would be vegetables. So let's say you use tomatoes. Tomatoes is a great one. It's all over the place. Everybody likes them. 1 or 2 cents. Let's say you're a large spaghetti making food chain like Olive Garden. A penny here, a penny there can really mess up their margin for the price fluctuation. So what happens is whenever they purchase oil or whatever, or they agree to buy something, like they agree to buy 10,000 gallons of fuel or 100,000 gallons of fuel, they also take what a derivative or some sort of policy against that, so that if the price goes around, they're locked in at a certain fee, so that they can set their sales cost or their sales price, and then they can have a solid expectation of gross margin. And so that's how derivatives help everybody. So they're not all bad, like on the film everybody's like, oh, they're just horrible things, right? And they are, some of them are, okay. The transients definitely are just not so good. But for the idea of helping business like maintain that variable cost at a certain amount and be able to plan to be able to charge prices. Remember that, like, if you buy an airline ticket, you might buy it 6 months. You may fly 6 months later, or you might fly 2 or 3 months later, and in between that, the cost is floating all over the place. So they have no idea, like, what it's actually going to cost you to fly. And I just recently did and I know I'm going on about this. This is a good point. I did a little read up on Southwest Airlines for another class, and I guess supposedly they only make like $5.80 uh, per flight. It was some really low number. Like the margins on some of these airline flights are so super razor thin that it comes down to like 4 or 5 passengers is the basic between profit and loss. So just, in our current state, the idea of the airlines flying around empty is just so frightful. So that industry is really going to take a hit um, in our current state of situation. So that's one example of a derivative. The other type of derivative, and I think maybe I'll just hop um, is foreign currency. So foreign currency, as you can imagine, you go in every day, you turn on the TV, it says the dollar's up against the French franc. It used to be, now it's euros and maybe it's Brexit, I don't know. But it used to be the dollar was up and down and all over. Japanese yen. I remember waking up with this every morning when I was a kid, down against the British pound, up against the French franc, up against the Japanese yen or whatever, and you hear this every morning on the business reports. So what happens is, let's say you go across the country and you decide you're going to go to some place. Let's throw out Iceland, all right? And you go out, you invest in a bunch of property, plant, and equipment, and you buy a bunch of property, plant, and equipment. You start your manufacturing firm. Everything is rolling really good. And then the government of Iceland has some sort of drama. For whatever reason, their money, their Iceland dollars, lose value. So because you have a value loss in another country, I mean, you're still successful, okay? You're pumping out whatever widget or whatsit or whatever you're making. But because of the loss of the value of the currency, you have an accounting difference. You have an accounting loss, basically, and you have an income against that currency loss. And so what we do is we buy derivatives, which are specifically there to insure us from these issues of foreign currency. So this is just kind of like a little overview. This happens to be one of my favorite chapters to lecture on because I happen to have a little bit of knowledge in this area. So I hope you enjoy this lecture. All right. So the idea of a derivative, and I've kind of given you an overview, is directly related to fluctuations of price. So and the rate. So remember, I was telling you about all the oil, right, for airline oil. Basically, as the price fluctuates, right, you still have to pay for the derivative. So whenever, let's say you're buying a derivative to keep it at $1 per gallon, or for the agreement to buy it at $1 per gallon, you have to pay a little bit extra from that, and that's where the people that make the derivatives make money. And it's a hedge. It's called a hedge. It's like hedging your bets. I'm sure you've heard that term, hedge your bets. If you play the whatever in the in the gambling industry. I'm sure you've heard that before. It can be an offset to a hedge to any potential fluctuation. Interest rates, that's another hedge you can buy. So you agree to lock in at a certain rate, for a loan. If you do a floating rate, like a LIBOR, then you could hedge against the LIBOR. So any kind of rate change. Commodity prices, I mentioned again, the oil, foreign currency exchange. And then also number 4, which I haven't talked about yet, is stock prices. You could hedge against stock prices. You could short, or you can, you can go against stock prices. Like, so for example, if you think the stock's going to go down, you can buy a derivative against it. And that's where we start getting into the term exotic. So the idea is that as the sales prices and costs and interest rates move around, you get the opportunity to insure yourself from that loss. Uh, so, for example, if the stock is going to tank, and you think it's going to go down. You can also kind of control your prices so that you can be able to offer a product and price it correctly. Um, you know, and then also it can produce tax benefits because you're spending money on them, so get a little bit of tax price benefit, and also keep you out of trouble. All right, so here's the different types of the four basic types of derivatives. You have forward contracts, futures, contracts, options, and swaps. So what is a forward contract? That basically is two parties getting together, and this would be kind of like on your Southwest oil buy or Southwest Airlines oil buy, and you say, okay, I'm gonna pay for 100,000 gallons for this particular month or whatever, and I am going to need that delivered at this particular price. And once I get this agreed upon, then what I'm going to do, I'm going to have to pay a little extra to guarantee that, basically. And then once the contract is over, then once you agree upon everything, then you settle the contract once the oil is delivered. So you can write a forward, and then as the oil is getting delivered, then you can, as it's getting delivered, or you can do what is called a settlement. All right. And the next thing is futures contracts. Okay. So these are a specific type of forward. So we have a forward contract and then a future. Okay. Which is a type of forward. And that's basically, they're set by futures exchanges. Okay. So when you wake up in the morning and you turn on Wall Street, okay, and you listen to the morning stock report, a lot of times futures is already going on. In fact, not a lot of times, it's always going on. So futures in the morning happens first, okay? So what happens is when I was telling you about doing the forward contract where you buy a certain amount of item at a certain price guaranteed, so you can kind of control your cost in the matter. Um, so if you go in and look, these are all kind of negotiated, usually ahead of the morning bell. So what happens is you'll hear on the radio, particularly if you're in the Midwest, like Iowa, Illinois, some of these very farm-rich areas, you'll hear corn futures are up, corn futures are down, and this is totally just negotiated over the exchange. And then you can either enter into another futures contract to settle, or you can go in. Basically, you can go in an opposite direction. That's kind of hard to explain without putting it up on the board, but you can make that. I would go back and review that in the book. Since they have a little explanation. Okay, so calls and puts. Okay, so options are the right to either call or put. So hopefully in your corporate finance class, you got a real good taste of this, maybe, maybe not. So the idea of an option is one person is obligated to perform depending on the election of the party to exercise their option. And there's this thing called In the Money, and maybe what I'll do is send you that video because I feel like that's just such a good explanation of calls and puts. It's just so easy to like explain, but basically what happens, and this is me watering it down for accounting class. You get a situation where you agree basically to exercise an option at a certain amount of money, or and buy a stock or sell a stock when it hits a certain spot, and then basically you just wait. And if it never hits the spot or gets too far away from the spot buy and sell, then your option becomes more and more worthless. So, depending on whether it's positive or negative. And that is just a really bad way to tell you without showing you a beautiful video. But basically, um, you want to make sure that, man, I just wish I could interrupt you really quick. Let me see if I can find that video real quick.
Okay, so I really hope that you enjoyed that options video. I like that video. I've used it before. Sometimes people just do great work. So let's just talk really quick about this forward contract. Here's an example of Irene delivering 10,000 items at a price of $10 per item. All right, and then Sun has determined that that's what their selling price is going to be and has locked it into the purchase price. So basically, Irene says 10. All right, Irene says 10. That's an I, by the way. Irene says 10 and Sun says 10. Okay, and so they're both like, they're agreeing on 10. All right, and then Sun, same thing. Irene and Sun both say 10. Right here, 10 too, right? Sun and Irene, everybody in agreement. So what happens to Irene, all right, if she agreed to pay, or he agreed, or whatever, Z agreed to pay 10, and then the purchase price goes down. Well, now we got a problem because we're locked into that 10. So Irene will lose money. The other side is Sun has made a great deal, right? Sun and Irene, Sun got it for 10 too. And if the purchase, or if for some reason the selling price in the market price goes down, Sun is still locked into that $10. So Sun gets a good gig. All right, here's the other situation. All right, let's say Irene and Sun get together, they say $10. All right, let's say the purchase price goes, let's say it goes up. All right, now Irene, let's say it goes up to 12, right? Let's just put the 12 in here. All right, goes up to 12. All right, well, Irene only pays 10. So Irene got a good gig out of this. However, Sun lost potential revenue had they not locked into this contract. So on both sides in a contract, there are opportunities, because once you lock in your selling price, for either side to lose money. So either side would write contract or forwards against that to protect themselves up against potential losses. And when you're dealing with items of, hundreds and hundreds of thousands of dollars, if it's a $1 difference, it could be $100,000 loss, or even, it can go even higher. So that's why we have these forward contracts. All right, so again, if Sun's fixed costs are 50,000, I'm just going to write it up here so you can kind of see it. The fixed 50, and the variable is 3. All right. Sun will lock in at price of 20,000, right? So it would be 100 minus the fixed costs, if that's their sales price. All right, minus the variable cost. I guess I could move that over here. Minus the variable was 30. It was 30, not 3. All right, minus the variable. You guys remember managerial accounting? Good times, right? Okay, so here again, and then this is going to be their locked in revenue. Okay, so if the market price increases, all right, if the market price, Sun can still sell and settle with Irene by paying her the difference, or simply sell it at the contracted. Either way, Sun is good to go. So they could still sell it with the impact of a forward contract. They would just have to settle with Irene, or they could sell it at the contracted price. Either way, Sun has a profit of $20,000. Okay, so that's our concept of forward. Let's look at foreign currency. So foreign currency, I talked about this earlier when currency, let's say you go overseas, there was a lot of globalization in the mid 2010s, whatever. Early 2010s, globalization was a huge thing. Everybody was doing it. Now I'm not quite sure, but what happened is a lot of companies, great example, John Deere, not John Deere actually, I think it was Caterpillar, went over to China and set up shop, and just a tough road for them because a lot of people thought what they did over here they could do over there. And there's different cultures, there's different rules, and it's very hard just as a manager to go over and be 3,000 miles away and still keep an eye on your shop. So that's when a lot of people used outsourcing too. So for example, they would take some product and they would make it, with less expensive labor overseas, but they run into some trouble just with, again, outsourcing issues that come. But when they set that shop up, say they set the company up over there, they're using the other company's currency, the other company's, factory, manufacturing to make the product. So you have to deal with accounting differences and also not necessarily all accounting differences, but you have to deal with loss of denomination or gain of denomination in currency. So what happens as a CEO, you sit there and you look at it, okay, and there's ways that you can sit there and manipulate, well, I wouldn't say manipulate your balance sheets, it's a little strong, but let's say you go to a foreign country and you have a gain on currency. Well, that wasn't an operating gain. Remember, operating is ultimately the report card. So when you're looking at the balance sheet, investments analysts really have to look at the currency fluctuations critically. The other side is there's a bunch of risk. Political risk is what happens when a company goes and puts their manufacturing overseas, and then the country itself that it's located in goes haywire. And a lot of political risk is reflected through currency fluctuations. So you would look at it as a manager, and you'd be very interested in how currency is moving around. There are countries that their currency completely went defunct. Great example is Zimbabwe, and another one I believe currently is Venezuela. So you really have to kind of watch that in your decision making. And as an accountant, you're going to be looking for that, or as you move into your level of CFO or financial manager, these are considerations that need to be running in the back of your head. Currency fluctuation is also just a great way to make money. If you're one of those options traders, just an easy job. I don't even know how to treat that in this class, but just a little side note. Okay, so the exchange quote, when you quote the exchange rate, remember I said up and down against the British pound. So for every $1.60 that you buy in US dollars, it would be 1 British pound. Okay, so the indirect quotation is 0.62 cents for $1, and the way you get that is to take the dollar and divide it by the $1.60. So this would be the reciprocal, and you can see that you get 0.62 pounds for every dollar. So you have to spend more US dollars to buy something in British pound. You would have to spend just a little bit more, or it looks like it wouldn't go as far, but really these are just kind of like the quotation amount. So maybe it usually, like if you buy something on Amazon, it's usually pretty close in price. Sometimes it's a little more expensive. All right, if you buy something overseas, I've done it before. So okay, so the next thing is establishing your exchange rate. It can be fixed by a government unit, and it can either be floating. Okay, so if you have an exchange rate that changes with changes in currency markets, or it can be fixed. All right. The fixed exchange rates are set by the government and don't fluctuate. The floating exchange rates reflect the fluctuating market prices. And that's more like the LIBOR is a great example of a floating exchange. All right, so now there's 3 other things. There's so much to remember from this chapter, but once you get it, you have it. And what's great about this chapter is as you go on in academics, these things continue to come right back up. Like you'll see this in your MBA program. This is not just advanced accounting based, all right? So a spot rate is an exchange rate for immediate delivery, and a current rate is at the balance sheet date, okay? And those are different times, or the time that the transaction takes place. The historical rate is when the rate that happened when the transaction occurred. So these are 3 things that you should be knowledgeable of definitions. All right. So let's look at sales and purchases in foreign currency. So the functional currency is in which they transact the majority of their business, like the dollar or the pound. The foreign currency transaction is any transaction that's settled in something that's other than their main currency. And it gets a little complicated because some of these companies that we're dealing with are international. Foreign exchange risk, and we've talked about this a little bit earlier in the video slide, is the risk that the foreign currency or the currency used in the transaction will change in value when compared to each other, and that the company will lose money as a result. In other words, outside of using the United States, this is an example, outside the United States, our currency will lose money outside of us. Okay, so the change in a foreign exchange rate, all right, if it increases your accounts payable, all right, based on foreign currency, like you have not bought any more items, it can result in an exchange loss. And if it takes your accounts payable down, all right, the change makes you owe less because of the fluctuation, then you have an exchange gain. These are both unrealized gains and losses from just having your AP in foreign currency. And the other thing I wanted to bring out in this particular slide is you can revalue all your currency in Microsoft Dynamics. So that's a little tidbit for basically going in and if you happen to be in this situation, you get this job, Microsoft Dynamics has a tool to do this. I just wanted to share that part. Also, this little quote here is something I pulled off the internet. So true, though. It is unrealized. They didn't really say the word unrealized. I want to make sure that was in there for your homework. Okay, next thing we're going to look at is foreign currency sales. You buy something, you sell something on account, you are now your sales, right? In a foreign currency, that can give you a increased accounts receivable if it's an increase in foreign currency, or a decrease, and all of a sudden you sell something on account and the currency devalues, then you have again an unrealized loss, so you have to adjust it. And if you get anything out of this class, remember Microsoft Dynamics has a beautiful tool to do that for you. All right, purchasing on account, here's an example. And this is where you get into the homework, the spot rate, and the accounts payable, right? As the spot rate increases, the accounts payable increases, and you have a loss because you have increasing accounts payable. All right, so here are the transactions. So the first thing again, it's unrealistic. I want to make sure you understand this is unrealistic. Here's where you do your accounts payable. Here's where you make your exchange loss and debit it as a loss. Here's where you had your conversion to cash once the funds are made available. And here's where you pay off your accounts payable and note the exchange loss. So basically, as the fluctuations happen, you just come in here and adjust your exchange loss up and down, gain if it was the other direction. Okay. Here's another example of selling it on account and the cash conversion, and you can see the 3 dates we have. Spot rate seems to be going up, all right, and that's at the date. Remember, the spot rate is not the date of conversion. You may not get it till later. You see the conversion date is on the 30th, and again, you can see here's our original book. Here's where we book the gain, crediting the accounts, or I'm sorry, debiting and increasing the accounts receivable to show the gain. Here's where we pay it and credit the accounts receivable, show the gain. And then here's where we exchange the cash from euros to dollars. Super simple chapter. I think you'll enjoy making all these journal entries. And that ends it. So I hope you enjoyed this lecture.